Goldman Sachs predicted China would overtake the US as the world's biggest economy by 2041. By 2003, China has transformed itself from the world's poorest economy to the second largest, and lifted hundreds of millions out of extreme poverty at a pace never before seen in history. But today, China is already showing signs of economic fatigue. According to China's 2023 July report, youth unemployment rate reached a record high at 21%, which is a slight increase from last year's 20%, which was already a big increase from 2021's 16%. In comparison, G7 nations like the US, UK, and Germany averaged 7.8%. And this is all while China is experiencing economic slowdown and real estate crisis. But what if I told you what's happening in China's economy is actually terrible news for the United States? And to understand why, we need to first understand how we even got here. And if you want to keep up with financial news but you just don't have time, sign up for my free daily newsletter covering the most important news in under 3 minutes. Link below. From 1979 to 2014, China experienced a sort of economic miracle. Economists measure economic growth with GDP, or gross domestic product. Basically, it's the total value of all goods and services produced within a country in a given time period. Producing Mr. Magic lamps, building public infrastructure, manufacturing vehicles. In just 3 decades, China's GDP per capita grew nearly 49-fold, experiencing an average GDP growth of close to 10% per year. To give you a sense of this magnitude, every 4 years since the 2008 financial crisis, China has added roughly an economy the size of India to its GDP. But China wasn't always like this. Up until 1949, China was plagued by poverty. Life expectancy was 36 years old. Hunger was the norm, and 80% of its population was illiterate. So what changed that allowed China to transform from one of the world's poorest economies to the second largest in just a few decades? In the 1950s, China saw that other countries like the US were entering its biggest economic boom after World War II. Wartime production boosted the US economy, creating countless jobs and raising wages. US industries like manufacturing quickly grew thanks to unprecedented domestic and international demand. The Chinese government knew they needed to catch up. The problem was, they didn't know how. They didn't have any advanced technology, and most of their people were both illiterate and starving. But they soon realized that they had one asset that no other developed country had access to, and they strategically transformed this asset into something every other country would depend on for years to come. In economics, this can be explained by the law of supply and demand. Basically, if there's an increase in the supply of a good without a proportional increase in its demand, the price of the good falls. And that also applies to people. China had the largest population in the world, and such an expansive labor pool means that businesses could hire workers for cheap, produce goods for cheap, and sell the goods for cheap. And the result? The world loved it and couldn't get enough. China's economy surged and quickly dominated nearly 15% of all global trade. But as the proverb goes, what goes up must come down. And what's causing their downfall is the very thing that allowed them to rise in the first place, their labor market. Specifically, the younger generation. China's youth unemployment rate has gotten so bad that they stopped publishing their data. Professor Zhang Dandan from Peking University even claims that China's real youth unemployment rate could be as high as 46.5%, more than 2 times higher than what the Chinese government is reporting. And looking back, it's clear that this labor problem was inevitable. There were 3 signs that signaled how the Chinese economy was set to evolve. Firstly, there's private companies to think about. Alibaba, Tencent, Huawei. The private sector contributes to more than 50% of the country's tax returns, 60% of economic output, and 80% of urban employment. The problem is, the Chinese government isn't particularly a fan of large private companies. It should be remembered that the Chinese Communist Party that runs the country is still, well, communist, and no one is above the party. This is Jack Ma. In 2020, he was the richest person in Asia with a net worth of $61.7 billion. His rags to riches story touched the hearts of billions and was even labeled as one of the most powerful people in the world by Forbes. But in October 2020, everything changed. Jack Ma stepped onto a stage in Shanghai and criticized the Chinese government. Shortly after, he went missing. His company's IPO was blocked by regulators, his companies were fined multiple billions of dollars. And the result? In just 3 years, Jack Ma lost more than half of his fortune. China's iron grip on its private sector makes companies more cautious about expanding their business. Naturally, when companies are cautious, hiring typically suffers. After it was scrutinized by the government, Alibaba, one of the largest Chinese tech companies in the world, laid off more than 10,000 employees. Country Garden, one of China's biggest listed property developers, cut more than 30,000. Tencent Cloud cut more than 12,000. And then there's this, and more. This situation doesn't only affect the current workforce. Graduates are also finding it harder to find good opportunities, as the Chinese government imposes new regulations intended to rein in private companies and maintain control. Next, China centered a good part of its economy around foreign investments. Apple, Goldman Sachs, Nike, these companies heavily invested more than just capital. There's technology, intellectual property, talent, and more. But after years of a stagnating Chinese economy, unpredictable government policy, and geopolitical frictions, foreign investors are turning away. Apple is moving its manufacturing to India, Jeep closed its factories, large investment firms like Scion Asset Management and More Capital cut their annual investments from $46 billion in 2016 to less than $5 billion in 2022. As a result, China's foreign investment gauge declined to a 25-year low. And this is only the beginning. This relocation of foreign capital will drive a large number of supporting industries and enterprises outward in the industrial chain. Naturally, when foreign investors and companies downsize or move out, employment opportunities fall. But private companies and foreign investments are only part of the problem. The other part is an unintended economic consequence that no one could have expected. But something you can expect is Moomoo, that's offering up to 15 free stocks. If you open and deposit $1,000, you get 15 free stocks valued up to $2,000 each. And despite the funny name, they are a registered broker-dealer with the SEC and is a member of SIPC, meaning you're covered up to $500,000. Get your free stocks, link below. When it comes to any developing country, over time, its people will become better off. More educated, more skilled, more wealthy, and an overall desire for higher standards of living. The problem for China is the labor market has a huge mismatch. Job opportunities haven't evolved quickly enough to accommodate the rapidly growing group of educated Chinese youths. From 2000 to 2018, the number of young workers with a college education has increased from 0.95 million to 7.53 million workers. Most of the available job opportunities are low-skilled: manufacturing, machinery, factory operations. But even then, these jobs require some level of skills which are very different from those taught in college. As a result, the Chinese labor market suffers simultaneously from an overeducated and underskilled workforce. Educated young workers can't find jobs that match their education levels, so they must move downward to significantly underpaid, low-skilled jobs. And on the other end, these firms have to put up with these underskilled but educated laborers. China's labor market is regressing, and Chinese youths are starting to push back. In politics, they call this group NEET. Not in education, employment, or training. Basically, it's a cultural revolution where the young generation voluntarily opt out of education and career competition because they don't see a point. You go to school 5 to 6 days a week, dedicate 55 hours each week to studying, participate in test prep factories, enroll in college, continue to study grind, then graduate and end up working in a factory that doesn't require any of the knowledge or skills you just spent your entire life studying for. Oh, and you're underpaid. While some people might think China's economic problem is good news for the US, the reality is China's economic contraction will change the world. When an economy experiences high unemployment, the economy gets weaker. Economists call this deflation. Basically, it's when the price of goods and services go down. Naturally, people who are unemployed tend to buy fewer things. Every time someone doesn't buy something, even if it's relatively small, the demand for that thing falls. And over time, the prices of that thing will follow. While this might sound like great news, everything's getting cheaper, it leads to a dangerous spiral. Studies have found that as prices of stuff keep dropping, this leads to lower production, reduced wages, decreased demand, and continued falling prices. If deflation ripples through an economy and nothing improves, consumers and companies will start to eat up their savings and ultimately start defaulting on their debt. But how does any of this negatively impact the US? In theory, if prices of Chinese products fall, it should mean that it's cheaper for the US to import Chinese goods. Instead of paying $150 for this super cool bike, you could pay $50. Instead of paying $2 for these cute pet clothes, you could pay 50 cents. Sounds like great news. The problem is, China is one of the biggest markets for US exports. China's purchases of US goods and services support more than 1 million jobs in the United States. US companies earn hundreds of billions of dollars from Chinese consumers. 20% of Apple's sales in 2023 came from China. But even then, that's tiny compared to other major US companies. There's Qualcomm and Monolithic Power, who both have more than 50% of their revenue come from China. Many international US companies have exposure and critical interdependencies there that could lead to a much bigger impact than just the value of the goods and services involved. The problem is, most of these companies are in sectors with the greatest growth opportunities. Out of the 10 S&P 500 companies most exposed to China, 80% are in the information technology sector. Then there's countless other industries where the US depends on China for: pharmaceuticals, rare earth minerals, and agriculture. When companies begin to lose revenue, a domino effect takes place on employment, cost of goods, and stock prices. Just 2 days after reports that China will ban iPhones in government agencies and state-owned companies, Apple's stock price lost nearly $200 billion of market value. And this doesn't even take into account the extent to which China is interwoven into the global economy. China accounts for half the world's basic materials consumption, a quarter of total oil imports, and is the world's second largest consumer market. Many countries, especially those in Asia, count China as their biggest export market for everything, from electronic parts and food to metals and energy. No matter your political view, the global economy has become so interconnected that if a major economic player, like China, starts to crack, the adage, "a receding tide grounds all boats," will hold true. But there might be a way to reduce China's economic impact on the US. Politicians call this decoupling. Basically, it's reducing US dependencies on Chinese products and supply chains. Things like increasing US domestic production of critical industries like semiconductors, tacking tariffs on imports from China to discourage domestic demand, and banning US companies from investing in certain Chinese firms. But successfully decoupling from China will be challenging, to say the least. It'll require two things. First, the US needs to restructure a large part of its own globalized economy, which would lead to, at least in the short term, big issues in our own economy. And second, it'll require other countries that are currently big trade partners and investors in China to join our plan. But what if I told you that China should be the least of your worries? What most people don't realize is that the core foundation of the US, the American dream, is actually dying. And for one of the first times in history, you're more likely to achieve the American dream outside of the US. Click here to learn why and how you can stop it from happening to you.